Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Wednesday, November 2nd, 2022. And our top story today, will home ownership be a thing of the past? And joining me now to discuss this and a lot more, Deidre Woollard is with the Motley Fool. Deidre, so great to see you. Thanks so much for joining us on the program this morning.
Happy to be here.
All right, I'm going to ask you a question. We can kind of start from there. Is home ownership a thing of the past, especially for millennials and Gen Z?
I don't believe it is, but I think that the way we are thinking about home ownership has changed a little bit. So your millennials, they're your biggest cohort of home buyers right now. I mean, biggest generation after the baby boomers, of course. But I think that they think about it a little bit differently because they think about it as a home, but also as a store of wealth. So I think that's kind of what's changing the picture a little bit, is they're thinking about it more closely as an investment. You see more millennials doing things like house hacking, like buying a duplex and living in half of it. So they're thinking about it a little bit differently.
Is that what it's called? It's called house hacking. I used to think that hacking, by the way, Deidre, was a bad term, but apparently it's a good term. It's finding an alternative to a solution.
Yeah, so a house hack is any way in which you have a property that you can live in and also get income out of. So it could be like a duplex, or you could put like an ADU on the property. So it's just a sign that people are thinking about traditional homeownership in a variety of really creative ways.
And certainly important, and it's about expectations, and maybe they have differing expectations. You know, when I grew up owning a house, that was like the American dream, and you know, you wanted to have a home and a place for you to raise your family. But now families, Deidre, are not really together. I mean, I live in Charlotte. My parents live in Baltimore. My brother lives in Massachusetts. I mean, this is the typical framework by which Gen Z millennials have evolved.
Yeah, absolutely. And another thing you're seeing with millennials I think is interesting is if they're living in an area where they can't afford to buy, they will buy a rental property somewhere else. So you're seeing a lot more of that. You know, in the past, you wouldn't see younger people do that, but now they feel more comfortable. Like, okay, if I'm living in Seattle and I've got some tech job, I probably am going to keep renting there, but maybe I'll buy a property in another market just so I have that opportunity to make money through that.
And let's be clear. We're going to talk about bubbles in a few minutes, but you know, markets. The way real estate typically does appreciate. I think what typically happens is that the velocity by which it appreciates can change as the market conditions. I think we're seeing that today. Am I right about that? Do markets typically appreciate, real estate markets, unless there's some kind of bubble or some other thing that happens that disrupts and creates market dislocations?
Well, I think it's kind of like the stock market. It depends on which slice you look at. Yes, real estate appreciates over time, but there will be small slices of time in which it will absolutely not. I mean, we saw that during the great financial crisis. So over time, it remains a solid investment, but sometimes you have to stay in a little longer than you anticipated.
Deidre, what about mortgage rates? And every article I read, whether it's from The Fool, whether it's another periodical, we see mortgage rates at historic highs. A lot of this is off of the federal, it's not a direct correlation, but it's indirectly correlated to the Federal Reserve raising rates. Is that a barrier to entry for many of these millennials, Gen Zers, and even Gen Xers like myself who are looking to buy property but maybe have not owned in the past?
I think it is a barrier for absolutely everybody. The mortgage rates hit over the 7% mark. We haven't had that in a long time. It's not a historic high. I mean, there were periods of time when there were 13, 14% interest rates in the 80s, but it is dramatically higher than we've seen in a long time. And the uptick was much faster than we've seen historically. I mean, we went from around a 3% interest rate to a 7% within the course of a year. So you're adding hundreds of dollars to every mortgage payment, and it's a really hard psychological barrier. I've been talking to a lot of people about this, some of whom are buying right now, and it's the prices of homes are getting more reasonable, slowing down. But the individual mortgage payments going way up, and that is a hard thing to swallow. Even if you know eventually it'll go back down, you'll probably refi, you're still dealing with a much higher mortgage payment, at least for the foreseeable future.
With the decline in home prices, a lot of people maybe incorrectly make the assumption that it's another financial crisis. And look, we have the 14 years ago, that impact, many of us it still shapes a lot of our home buying and our investment philosophy, right? I mean, the bottom was really pulled out from a lot of people. First of all, is this in any way similar to 2008? And should people be concerned about the depreciation of some of these home prices? Or is it, as we're talking about, just a recalibration of the market vis-a-vis with interest rates?
I used to be a hard no on a housing bubble. Now I'm a not yet. And here's why. We've got the inventory still low, right? About 3.2 months supply on the market, according to NAR, which means that you're still in a market that is more favorable to the seller. But here's the thing. We can't seem to budge that because everyone who has a mortgage has that nice low mortgage and they don't want to shift. But you also still have this large cohort of baby boomers who eventually are going to sell. In some markets, I'm seeing some weakness. I'm seeing inventory go way up in places like, in Austin and Phoenix and in some of the hot markets that really came up during the pandemic. So if there is a crisis, it is probably going to be more geographically specific.
And to that end, and I want to kind of split this next topic into our second segment. I want to talk about potential real estate bubbles. Are there, when you look around the globe, not just here in the U.S., because there's real estate investing going on everywhere on the planet, are there particular areas that, as an expert like yourself, pop up and you say, there may be a bubble, or maybe it's a geographic location here in the States where there just may be too much house or too many houses for the marketplace?
I think this always happens. A market gets hot, whether it's here in the U.S. or somewhere else. Investors pile in, everybody gets very excited about it, prices go up, and then something happens either geopolitically or economically, and it shifts. This is something that we have seen, kind of throughout time.
And Deidre, I want to carry this conversation over. I need to take a quick commercial break, which I know you and the audience are very familiar with. When we come back, we'll talk more about whether there is a real estate bubble here and across the globe, and we'll get some real estate predictions for the remainder of 2022. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking this morning to Deidre Woollard of the Motley Fool. Deidre, thanks so much for sticking with us this morning.
Excited to be here. I like talking about these bubbles.
Yeah, and obviously very important. A lot of people watching this, they were sitting on the sidelines for so many months, maybe even years. Now that prices have come down, interest rates have gone up. But when you look around the country, here in the U.S., are there particular areas that stick out to you in terms of a quote-unquote bubble, or an area where there may be more depressed housing than is typical?
Yeah, there are a couple. You and I looked at a USB report that you sent me that I think is pretty interesting and talks about the California problem, about San Francisco and Los Angeles potentially being overvalued. Another area I'm looking at, of course, is Austin, Texas, just because it's grown so much during the pandemic. I'm also looking at Phoenix, Arizona. That's another place where, that was at the top of the Case-Shiller price index for about a year as prices just kept going up, but they may be overbuilding there. So I think there are a bunch of places to be looking at right now in the U.S. and, of course, internationally.
All right, Deidre, let's go to some predictions. And I'm not a big fan of predictions because they're usually never spot on. And if they are, it's very luck. There's a lot of luck involved. That's just my opinion. But you're an expert and you are really listening to what is going on in the marketplace. So number one, what are some of your thoughts about where the remainder of 2022 looks? Like, for example, will mortgage rates go beyond 7%? If the Federal Reserve continues to raise rates? I think they're expected to raise rates another 75 basis points.
Yeah, they are. And that, as you said earlier, they're not strictly correlated, but they definitely move with each other sometimes. How high can we get? I think seems to be the question everybody's asking. I don't see it going too much higher. Maybe we hit 8, but I think that we're going to see it scale back over the next year, hopefully, to a more reasonable rate. I don't think we're going back to 3% anytime soon, but I think a 5 to 6% over the next year seems pretty reasonable.
And what about rents? I'd be remiss if I didn't ask you about. We talked about rents in the first segment in the sense that people were still thinking about renting, but from what I've read and in talking with you, rents in major metropolises or metropoli, whatever the appropriate grammar is there, they've gone up significantly. New York, Los Angeles, San Francisco. Will they continue to rise? And is it more economical rather than buying to continue to rent, even if those rates are going up by 5, 10, 15, 20%?
It definitely depends. I think we're going to see some good news on the rental front. One of the things that happened during the pandemic is we saw a sort of slowdown in building, right? We had supply chain issues, things like that. There's going to be a lot of supply coming on the market in especially those major metros. So that should be good news. I think we're probably going to see rent start to stabilize. It's not going to drop big anytime soon, but it's definitely going to stabilize. So that should be some relief. I mean, as far as renting versus buying, it's so market specific and really it's also sort of your life specific depending on where you're at and if you think you're going to stay somewhere a long time. If you don't think you're going to stay somewhere for 5 years, it may not be time to buy.
I got to tell you, Deidre, I like the flexibility of renting, especially if you move into a new area. And if you move into a fairly decent or newer building, you have newer amenities, you have newer microwaves and appliances. There's something to be said about that flexibility, that ability to get up and move. Now, on the flip side, moving is a real pain in the rear end. I mean, I do not enjoy packing. My wife doesn't enjoy packing. The cats don't enjoy packing. It's not fun at all.
No, it's not. And, it's funny. There have been a couple of startups to try to figure out how to kind of hack moving. There's a couple of them that where you can sort of rent your furniture and get, a whole new set of furniture. But really, there's nothing that really makes moving much easier. And I think that's one of the reasons that people tend to stay longer in their houses. It's another reason that people want to rent single family rentals. One of the reasons that they have boomed is that people want a house sometimes, even if they can't afford to buy one.
Last question about commercial real estate. I can't let you off the hook. We've talked a lot about residential today, but let's talk about commercial and that, during inflationary times, real estate has always been a pretty decent hedge. Is real estate still the best investment during inflationary times? And what does that look like in terms of an investment, at least in the short run? When I say short run, I mean 6 to 12 months.
It's very sector specific. So industrial has been really hot, but then we've seen companies like Amazon pulling back on how much warehouses they need. I still like industrial as an investment. Office, we've talked about before, it's pretty iffy right now. I still like grocery anchored retail, or like the sort of essential retail, I think is a really safe place to be.
And does some of the tech challenges that we've seen, because tech was very big, and I want to tie in what I was talking to your former colleague Daniel Klein about on our Sunday show. Amazon, Apple, some of them reported earnings. They weren't great earnings. And if you recall, you and I talked about data centers, the Metas of the world, and Google buying buildings in New York City and other places, building campuses like Apple did. How do you resolve the lower tech earnings against real estate, especially in the tech sector?
Yeah, I'm watching layoffs a lot, and and we are seeing a lot of layoffs in tech, and they're not over yet. So, yeah, Facebook has they gave back some leased space in New York. We've seen other companies do that. Salesforce is leasing out part of their building in San Francisco. You're seeing a lot of subleases, which is a sign that companies are thinking differently about. Maybe they made a commitment for 5 to 10 years. They decide they don't need that space, they're going to try to sublease it out. It's really challenging. WeWork has gotten out of a couple of leases in California. There's a lot of shifting happening on the office front because companies don't seem to know right now how many employees they need or how many employees they need to cut in order to maintain their budgets.
And last question, I lied about that being the last question. I'm sorry, because as you were talking, I don't pre-write questions, so as you're talking, you're generating some really interesting ideas in my head. And I guess my last question for you, this is truly my last question. You mentioned about offices and businesses not knowing how to staff. Look, everyone that you talk to, from Jamie, not you that we talk to, but you hear from Jamie Dimon down to any economists say that there could be a recession coming up into 2023. How does this play against the commercial real estate sector? Because businesses need employees. They may not know how many employees they need, but they need employees, and they need a place, at least for them to go visit from time to time. So what does a potential recession mean to commercial real estate?
I think it depends on how long it is. That's one of the things that we're, as we watch these numbers and we start to hear about recessions, I think mostly a lot of people, even the Jamie Dimons, are predicting a short sharp. A short sharp won't disrupt real estate too much. If it's just a recession where we have, a couple of cycles of, lower economic growth, that's fine. If it's a prolonged one, which I don't think we're going to get, that could be a little more concerning. But overall, yeah, we're going through an office reset. It started during the pandemic. It is still shifting. I think one of the things that we are seeing, though, is a lot of companies that are concerned about profitability. They may have fewer employees, but they want those employees in the office more. And the sort of the balance of power has shifted back to the employer, which means if they say you need to be in the office, then you're probably going to want to be in the office. Yeah,
especially if you want to keep a job. If not, you'll become a freelancer, or you'll do your own thing, or you'll go work for somebody who is looking for somebody with a little bit, giving them a little bit more flexibility. Deidre, it's great to see you as always. Thanks so much for stopping by. Really appreciate your analysis, and we look forward to having you back on the program again very soon.
Thank you so much.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to? Drop us a line, and don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? Well, visit our website, and of course, all of our streaming partners. We're back again tomorrow for another edition of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Waiting here for you to take and drink of. But if you're tired, come on.
Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.